That's a classic mistake. One I never made. I could tell you, that's the biggest thing I did right for my clients, was to make sure they knew these are the times to buy, and they were always positioned never to get out. There's an old saying I used to say, Allie, you don't pay me to get you in, you pay me to keep you in.
When you need some advice, never sacrifice, always get it right. Ask the Planman. Finance, insurance, and more.
Hi, everybody. Welcome to Ask the Planman. I'm your host, Bruce Weinstein. I think everybody in life needs to have a plan to be proactive, take charge, and control the direction of your lives when it comes to your personal finances and insurance. Today, I'm going to be a little bit vulnerable with you. I've got my producer, Allie, with me here today, and we were thinking about sharing mistakes that I've made over the years. Been doing some soul searching, thinking about where I'm at this stage of my life. I'm now 61 years of age. If you've listened to some of my other episodes in the past, I lost my business in 2016. I drove Uber in 2017. And it wasn't until COVID in 2020 where we actually relaunched Weinstein Wealth Insurance Solutions. And then a year after that, came up with the idea of Ask the Planman. And so it's not a matter of the mistakes of what happened there. That was a business situation that I got unfortunately caught up with. But as I reflect back in my 40 plus years in the work world, I remember, Allie, the first job I got, 1985, right out of college. I was making $19,000 a year. And they offered me the opportunity to participate in their 401k. And 401ks were this new thing. And I could put away 10% of my salary, $2,000, $1,900. And God, that was a lot of money. And it was a challenge to accept at 22 years of age what that money would mean to me if left alone and just working and compounding now 40 years later, almost 39, and where the stock markets are. And I got involved in the stock market a year later. And in 1987, the market crashed. And, you know, I always struggled with managing clients' money. We were paid commissions. Transactions were the way you made your money. And so I never really learned that buy and hold mentality of just buy good quality, reinvest dividends, and let the money work over time. I was always in and out, trading, playing options, quick hits. And if you go back to the lessons that Warren Buffett talks about now, and somebody that I've followed over the years, as most people have, the key to success is not losing money. The key is compounding your money, even if it's only at 4 or 5% and not 10 and 12%. And what that money can do, you and I have done the camel hump story, the compounding of money on some of our episodes. And I forget the exact number, but there's a meme out there is if I gave you $5 million or I gave you a penny that compounded every day for 30 days, which would you take? And the math is the penny. The penny will compound out by doubling 30 times, 1 to 2, 2 to 4, 4 to 8, 16, 32, 64, and on and on. And that the power of compounding the last 4 or 5 times will surpass the $5 million lump sum. And so a younger person starting out, whether they're in high school or junior high school and setting up a Roth IRA and putting away $500 and putting it in something that's not going to lose long term, not playing games, not playing the memes with the kitty cat guy and the what was it, the GameStop stocks, right? Well, I mean, Bitcoin's a little bit different, but
it was Dogecoin, I think it was.
Yeah, Dogecoin, stuff like that. So look, my problem became not having the majority of my money properly structured and always playing gambling and taking speculation, because I was making a lot of money and I could always replace that money. So if I lost $5,000 on an option trade, next month I'll have another $5,000. Well, guess what? You do that 4, 5, 6 years in a row, 5, 10, 20 grand just keeps disappearing. And now multiply that 30 years later, I could have had millions of dollars. So you look back to 1985 and putting $2,000 in a 401k when the stock market was less than 2,000, it's now 40,000. The compounding of that money in the S&P 500 or something just blue chip, safer quality, diversified, making a compounded 10%, let's say. Well, 10%, your money doubles every 7.2 years. So call it 7. So what, 1985. So 85, 92, 99, 06. Wait, I missed, did I get it already? 1985. 1992 is the first double, right? 1999, 2006, 2013, 2020. That's 5 times already, coming up on 6. So go back. 2 becomes 4, 8, 16, 32, 64 would be coming 128,000 on that one $2,000 investment. Now go back and do that for 30 years. Go back and do that for 40 years. So you'd have 128,000 to the 30x. That's like $4 million. Okay. So if you just, and that's only $2,000 and that's only at 10%. So now you put away 20 grand. 20 grand's $1.28, right? So when we talk on the show, we talk about proactivity, planning, compounding of money is your biggest ally for you young folks listening out there. When my kids got W-2 paying jobs in high school, we funded for them Roth IRAs. Why? Roth grows tax-free, Roth comes out tax-free, and as a student, they're exempt from tax. So if Josh made $2,000 working at Best Buy, he got to put the whole $2,000 in a Roth. And now that money just compounds and compounds and compounds and compounds. And you do that for a 17-year-old. I did that as a 22-year-old. We just did the math, but now add another cycle, another camel hump. Now the money's doubling 7 times to my 6. And if you made 12% instead of 10%, your money doubles every 6 years. But if you lose it, folks, if you're playing games and that 2,000 gets wiped out, you're 61 years of age and now that money doesn't exist. I don't even have that $128,000 because I didn't fund that money back then. And I'd be looking at 150 grand today just from that one deposit. Big mistakes. I look back now with I try not to live a regretful life. I made decisions in the moment with what you know. And I've never really lived in a regret moment. But boy, you think about that, Ali, and it's like, man, that and Apple stock and buying Apple stock back in the day and Microsoft and all these other tech names. Mm-hmm. Google. I had a client buy Google, but he bought $1,000 worth of Google when it first came out at $100 a share, and everybody was like, "Oh, what are you buying that stuff for?" And he's 90 years old now. He bought it 30 years ago, 25 years ago on a whim.
It's one of those things my mom still to this day kicks herself because I think she had, if I'm not mistaken, like 30 shares of Google when it first opened. And then the prices started going up and she sold it when she thought it was hot. She had no idea how hot it would get. Yeah. Sold it too soon.
Most of them. So, but now as I take that direction, that's the difference of buying an individual stock and building a portfolio of stocks versus a mutual fund. And again, being in the business all those years, I thought I was, the slyer fox and I knew better. So my money wasn't, properly spread out in mutual funds. I was picking stocks. I was trading options, right? I was more aggressive. I was speculating. So, and then, hey, Apple's up 50%. I'm going to take my profit before it goes back down because I've been conditioned in my 38 years to see a lot of stock market corrections. And so the profit's no good unless you lock it in and take it. So when the stock goes up 40, 50% and the price targets are being hit and every analyst on the street says, sell it at 100. Well, who knew 15 or 20 years later, it's 1,000, it's 20,000. Yeah. If you go back and look, and I eat my heart out at this one, when the market crashed on the financial housing crisis, 2008, March of 2009, Apple bottomed at about $75. Probably cut in half. It was about 125, 150. Okay. You look at Apple stock today, which is around $200. You don't realize, if you're not following or own the stock, Apple split twice during that time. And 100 shares is 2,800 shares today. 2,800.
That's a big
So
one.
your $75 stock, 100 shares is now 2,800 shares at $200. What's that math? It's like 560. It's like 560,000. So your $7,500 is worth over $500,000 if you bought the stock at the bottom.
Big difference.
And you can go down the list. You can go down the list. Tesla, Nvidia, all those names. But again, who knows and who's sticking it out? Who's going to sit on that money for 2009 to 24? It's 15 years it took to get there. So it's not an overnight. And now all of a sudden, think about it. If you put in $7,500 into something and it's worth 20 grand, you're pretty happy. You're going to be like, hey, let me put that in something else, or let me go buy a car, or I'm going to take a vacation. And you think about pulling that money out. Opportunity cost, right? We call this the opportunity cost episode. Every time you buy something, I want to get a shirt. I want to get a new car. I want to buy a watch. Well, that $10,000 watch, what's that going to cost you over 30 years if you put that money in a investment, in a vehicle, something that generated cash flow? It could be real estate, whatever it is. That's the big movement we've been hearing about the last decade or so, is having passive income, your money working for you. Most people don't understand the stock market and they don't trust the stock market. So real estate's become a little bit easier branch for people to get involved with, and the explosion of Airbnbs, right? But what happens when the economy turns down, right? I've been looking at properties. I've been debating on moving into some of that. But I've never had good experience in real estate. I had a rental property in Arizona where my son went to school there, and they trashed the place. I put all this money into it, fixed it up, and they destroyed it. And I couldn't wait to get rid of it. And of course, he's out of school, since 14? So 11 years later, Ali, that $200,000 house is worth over $500,000 thanks to COVID. But I got rid of it because I didn't want the headache and the aggravation, my tolerance for it, being a landlord, dealing with college kids trashing your house. Again, but regrets. Regrets. Yeah. I had a few,
Similarly, we actually had 3 properties at one point that we were renting, 2 duplexes and a single family. And during the start of the pandemic, we saw those prices starting to go up. There was a lot of maintenance needed for those houses. We started weighing the pros and cons of, do we want to deal with the maintenance? Do we want to just sell the houses? So we ended up just deciding to sell the houses. And if we had just waited another 3 years, that house, the single family home that we sold it for at 190 is now over 300. The duplex that we sold I think we sold it for around 200, is now over 400. And that was 3 years. 3 years is all we had to hold on to those houses, and we would have made double what we ended up selling them for.
Right. And you're a lot younger than me. Imagine having it 30 years from now. And that's, that's it. I think to emphasize this as the individual listener, you have to know your own tolerance and desires. I've never had success in real estate. So how fast do I bail out every time I'm involved in something? My timing has always been terrible, but now I look back and go, oh, that townhouse I bought in 1987 and I sold in 1998 is now 5 times what it was. But the window I owned it and sold it, I lost money on it because the downturn in the real estate market of the 80s and the 90s. But if I bought 5 of them instead of selling it at 100,000 in 1998, well, 20 years later, 25 years later, they're $500,000 units. Shame on me, right? But, nobody educated me on real estate, right? I didn't come from a family that invested in real estate, taught me those things. I got involved in the stock market as a stockbroker. And so that became my playing field. That's where my comfort zone is. So buying the market, understanding the market, investing in the market, dividends, covered calls, mutual fund, I understand all that. And obviously look back in the game and see the success I've had from my clients over the years, for those 30 years, but never had it with the real estate side. And now at 61, I'm like, what am I doing? Right? Do I really want to become A real estate person now, like I don't have 30 more years to wait it to come to fruition, right? So now the older people, and again, here's trap number 2, lesson number 2, is the 40 and 50-year-old that wakes up and starts to play catch up. They didn't do it in their 20s. They didn't do it in their 30s. Now their kids are getting ready to go to college. They're getting done paying for college. And they wake up and they're 50 and they go, I don't have anything put away for retirement. I've been living paycheck to paycheck, buy my home, my kids, get my kids through school, live modestly over the years. And now they're 50 and they want to catch up and retire at 60 or 65. And oh, by the way, isn't it funny where you have IRA and 401k that has catch up provisions in the title of the program, right? You can catch up when you're over 50 and put more money in than somebody under 50. It's catch up time. It's actually designed for knowing most people in society have to play catch up, right? That's terrible. That's terrible. But the difference between the 20-year-old and the 50-year-old is what? It's 30 years of compounding the money. They'll never catch up on those camel humps. Folks, do we hit you with a couple of pokes in the eye? Like, are there some lessons here you can think about? Can you look at what you're doing in your retirement plans? I had a call there. I'll give you one. I had a call the other day from a client way, way back. His life insurance, I put him into 20-year term life insurance 20 years ago. Okay. He won, right? As they say, he won. What does that mean? It means he didn't die, right? Term insurance is winding down and he never had any investable dollars. We just did some insurance. He follows me. He's a fan of the show. Always, tags in on things and comments and likes, and he's a good advocate. So thank you, Abe, for that. But I designed his 401k, his retirement plan at work. Technically, I think it's a 403b, which is he works for a nonprofit. No big deal. It's same concept. Okay. And he's been putting money in there based upon a model of an asset allocation I gave him. And he hits the magic rebalance button. So he said it's all on autopilot. He doesn't really pay attention to it. And it's not like he sends it to me to review every year over the years. So it's just sat there. Well, lo and behold, with very modest investments, and I'm telling you, like he does 2-3%. He's never been he's got a young family. He's the only one that makes an income. So, he put away, there's no match. So, he's put away what he can, what he deemed to be affordable, but he's got $250,000 in that thing because he just did it. He didn't pay attention. He didn't worry about stock market declines and let me go to cash and play games in the short term. He just put it on autopilot, like I told him, literally 20 years ago, and putting $2,000, $3,000, $4,000 away. Maybe he put 80 grand in. It's worth $250,000. And he's 52 years of age, and he's still got another 10 or 15 years to go. So now his income's moved up. We've talked about him bumping up and getting much higher contribution amounts, right? And that, all right, you still got a couple more camel humps, right? If he can make 10% and work 14 more years till he's 66, $250,000 becomes $500,000, $500,000 becomes $1 million, plus whatever he adds into it. And all of a sudden he'll have a nice $1.5 million, type of nest egg. But that's the journey, right? That's the lesson. That's what he started doing at 32. But he was 10 years short, right? He didn't start at 22. So imagine if you go out there, the lesson for the young crowd, my teenagers, my college and high school students, dude, put that $1,000 away. Buy an S&P, go to Vanguard, go to Fidelity. You don't need anything smart. You don't need to pay advisors. Just buy an S&P 500 mutual fund. That historically has a double-digit rate of return of 10 to 11%. Ebbs and flows. You want the market to go down as much as you want it to go up. You want Allie, how old are you, Allie? Can we share that?
Oh, yeah, I'm 36.
36. Okay, she's 36. If Allie was to put away $5,000 a year in the S&P 500 for the next 30 years, does Allie want the market to go up or down for the next 29 of those years? She wants to go down, folks, because she wants to buy cheap. When the
Buy
markets
low,
go
buy.
down, people buy more shares. You're trying to accumulate shares. But psychology wise, we want to see it go up. But if I have a chance to buy Apple at 75 and I only have $100, I'd rather see Apple go to 60 the next time I have $100 and 50 and 40. And I'll just keep putting my $100 in as it's down and eventually wait for it to go back up, right? And then as I get closer to retirement, now it's 100, 200, 500. Well, now I got to accumulate all my shares, but we don't have that opportunity. So people look at a stock market correction as a bad thing because everything they have in it went down. But that's the buying opportunity. That's when you move your stakes in and buy more and take advantage of the sale. But in 2008 and 2009, all my under 50-year-old clients bailed out. Didn't trust the market. They just lost 40%. Maybe they didn't take their money out, but you know what they stopped doing, Allie? They stopped putting new money in. Wall Street was on sale 40% off, and they didn't want to buy. And now look at where it is. It's quadrupled, tripled, quadrupled. We just said you could have bought Apple at $75. It's now 56,000, 5,600, whatever the math was. Okay, 28 times 75. Okay, some crazy number. You didn't put your money to work. You didn't want to buy it at 75. It just dropped from 100 and a quarter, 150. You're losing half your money. I'll sit on it, but I'm not going to buy more. But if you bought more, that's where the money's made. Clients decided I'm going to put a pool in. I'm going to finish my basement. I'm not going to contribute to my 401k for a while till the market went back up. So a couple of years later, now they start throwing their money in. Well, now they're paying par. They're now getting a 40% discount. So, Allie, when you go to the store, supermarket, Macy's, Kohl's, Neiman Marcus, you ever happen to glance over at the 2-for-1 rack at the supermarket or what's on sale?
Or the clearance rack?
The clearance racks? Like, don't we as consumers shop looking for sales and bargains? I don't wait for the sale at Macy's to go over and then say, now I'm going to buy that tie. If it's 30% off on a Black Friday sale, I'm going to buy 5. The sale's over on Monday. Am I going back in there and saying, okay, now I'm going to buy them? The sale's over. Let me go buy more. No. But as consumers, we don't do that with the stock market. We don't do that with our investments and our portfolio. People are like, oh, I'm not buying it now. That's a classic mistake. One I never made. I could tell you that's the biggest thing I did right for my clients was to make sure they knew these are the times to buy and they were always positioned never to get out. There's an old saying I used to say, Allie, you don't pay me to get you in, you pay me to keep you in.
Well, it just made me think of that saying you always hear people say of buy low, sell high. And as we've been talking, that I think that maybe should say is buy low and hold.
Sure. Well, again, I don't want to go down the rabbit hole of asset allocation on this episode, but if you're an asset allocation advocate, you trim. If you follow Kramer, if you follow Warren Buffett, they still trim their portfolios. So it's not a matter of getting out. It's a matter of rebalancing so that any one position doesn't become overwhelming with the rest.
Yep.
So if Apple, again, we don't try and timestamp the episodes, but this past week, it was announced Warren Buffett sold half of his Apple stock, which was over $200. But he's made so much money in it. It's probably just a classic rebalance is it became too large of a position in his holdings. Mm-hmm. So if you're an individual stock buyer, the rule of thumb, most money managers will never have more than 4 or 5% of their money in any one stock. So if I buy 20 stocks at 5%, and Apple now becomes 15% of my portfolio because it's done so well, it's not that I don't believe in Apple anymore. It's I don't want 15% of my money in that one position. So I'm not giving up on Apple as much as I need to diversify. the Bill Gates and the Mark Zuckerbergers and Jeff Bezos, Elon Musk, they have random windows where they sell some of their stock. And people are like, oh, they're giving up, they're selling, they're bailing out. No, they get stock options. They get new awards of stock every year. But it's 99.9% of their wealth in their portfolio. And so over the years, Bill Gates kept selling a piece and diversifying into other assets and asset classes. He's one of the biggest farmland owners in the United States. Do you know that? Bill Gates owns farmlands in like 10 states, if not more. And he's the largest individual farmland owner. I don't know what he's going to do with it. There's a whole subtopic episode there of what he's planning and doing. But the guy's worth $1 gazillion, and he's given away billions of dollars as well. But they diversify. They have to.
Yeah. Especially once you start getting dividends coming in. Maybe you've got a stock with, with Apple, like you said, and you've got dividends coming in, and those are automatically being reinvested, and you've got so much of it. It's no wonder you end up with this kind of like snowball effect happening.
Growth stocks like Apple, Microsoft, Amazon, and the like, Google, in their day, never paid dividends. Nobody wanted dividends. They've only recently, over the last, I think, literally the last 12 months, have most of them at least started to even initiate a dividend. Apple had one a few years back. It's like barely 1%. But no, as an investor in the company, you wanted them to put their money back into the company and grow and expand and research and development or acquisitions, because the growth would be faster. Now, people look at companies that buy back their stock. So if you buy back stock, you're investing in the company, you believe in the company, and you're also reducing shares, which elevates the value of the existing shares. So stock buybacks, dividends, you tend to see those in more maturing companies. Maybe they're sitting on so much capital, cash, billions of dollars in reserves. They don't know what to put their money into anymore. So they buy their own stock. Like, you know what? I like my stock at 150. And all of a sudden the stock's up to 200 because they've been buying their own shares back, and it elevates the price. So again, depending who you listen to out there on Wall Street, stock buybacks are a trigger, dividends. Usually a retiree will be a little bit more in tune with the dividend. A 30-year-old may not want a stale older company that just pays dividends, but pharmaceutical, telecom like Verizon, AT&T, oil companies, Ford and GM. Ford these days has a pretty good dividend, but their stock just got whacked. Again, I'm not trying to talk individual stocks to anybody, and you got to do your own homework and research. I'm not here to promote anything in that regard. But, when you're looking at the investment papers, there's value and there's growth, and they do different things, and they don't always work together. Sometimes they work in tandem, and sometimes they're in contrast. Sometimes growth gets hot. Sometimes value gets hot. Guess what? Over time, they balance out. Stocks make on average around 10 to 12%. That's the historical rate of return, whether it's value or growth. Growth might have a faster run up, but growth will crash a little harder, and value will be a little bit more stable, which is why you diversify, why you have a portfolio that has value stocks and growth stocks. When the market took a hit the last couple of days, the value stocks all went up.
I sense an entire episode around all of this.
We thought we had nothing to say.
Nope, there's plenty to say. We've got another episode lined up now.
All right, listen, call to action, folks. Be proactive. Let's summarize what we talked about. We'll bring it home today. This is another episode of Ask the Planman. I've been talking about some of my regrets, how I want you to learn from some of my mistakes. I want you to go out. I want you to start investing as fast and as early as you can. Be prudent, be practical. The key to the game is not to lose money. Not to lose money. The more you have, the more you keep, small rates of return. Let that money compound and grow for you. Think about doubling a penny every day for 30 days. Go hit your calculators and figure that out. Shoot me a text. Hit me up at asktheplanman.com, my Instagram, Ask the Planman, YouTube, anywhere. Comment on the show, like, share. Please subscribe. Please share these episodes. If you need some advice, always get it right. Come Ask the Planman. I'm your host, Bruce Weinstein. Next time, Allie, thanks for being with me. And hopefully we've changed somebody's life today with this riveting conversation on compounding the money. I'll see you soon.
Need some advice. insurance, and more.